Christian, great to have you on the show. And let's start right there. How can investors get exposure? Talk to me a little bit about your fund, which is different than a more traditional closed-end fund.
That's great to be with you as well. Yes, it is. Yeah, so unlike traditional private equity, venture capital style funds, which have a 10-year fund life, which ends up being much longer than that in most situations, large minimum investments, extensive subscription documents, tax burdens, et cetera. We have a fund that's utilizing something called the 1940 Act interval structure, which in a sense provides for democratization of access to what we focus on, which is late stage venture and growth strategies. And it does so with a variety of operational efficiencies. It can be purchased with a ticker. It's designed primarily for retail and for registered investment advisors. There's more friendly tax treatment. There's lower minimum investment sizes. For instance, an investor can access our portfolio of nearly 100 late-stage innovation companies for as little as $2,500 investment. So there's a lot of operational efficiencies that come with it.
Yeah. So JP Morgan saying, quote, "We remain cautious overall on alternatives versus publicly traded traditional asset classes, given a still significant gap between private asset versus public market valuations." If an investor was going to put money to work in the private shares fund, how can you ensure that the shares of the stocks underlying the fund are not overvalued here?
Yeah, it's a fantastic question. So historically, the way that most private equity and venture firms are required to value their portfolios is on a quarterly basis. And they often have time after the end of that quarter to adjust those, to publish those capital account statements, but they almost always use the last round valuation. When you're managing a fund like ours, which allows for daily buys, meaning investors can purchase it daily, you have to incorporate more dynamic pricing mechanisms. So we not only look at last round, we also factor in things such as public comps, so trading comparables for our companies. If there happens to be exit activity, as you mentioned, Morgan, there hasn't been a lot of that lately, but we'll look at exit activity. In the private market, some of these securities will trade privately. That's sometimes how we access them. It's called the secondary market. So we'll look at how trading activity is behaving for secondary trading prices of companies. So we essentially look to integrate a variety of more dynamic valuation inputs to provide what we think is a generally more direct indication of current fair market value. Okay. There's no exact science to perfect this, but we think that provides a better indication than just looking at last round, which could have happened 2 years ago, as you know, in the plated market.
Christian, may be better, but it still seems awfully dangerous. I'm taking a look at your fund. It looks like the price peaked, as one would expect, in late 2021. You're only off maybe a little bit more than 10% from there. Meanwhile, a lot of these newer, earlier stage public companies have come way down from there. So it seems like there might still be a lot of revaluing to come. So should investors be aware of that this is not as liquid as the public markets if they're thinking about putting in money at a time like this?
Well, investors absolutely need to be aware when they're going into any private market strategy of the liquidity profile that you mentioned, John, so 1,000%. However, you have to understand there's a bifurcation in the market, kind of like the public market. So in the private market, for instance, in our portfolio, we've had many up rounds over the past couple of years, even in face of a more challenging environment, because high-performing businesses are still raising capital. Now, it may take longer. They may not get the same multiples they had 20 months ago, 24 months ago, but the high-performing businesses are still not having too much trouble raising capital at flat or up-round valuations. Companies that are not as differentiated, that are experiencing more challenges to their operating metrics and that are more capital constrained, those are absolutely more prone to down rounds, perhaps being sold off on the cheap or perhaps going away. So your analysis is not wrong, but there is a bifurcation in the market, and you have to be careful about that. But there is absolutely risk to liquidity in any type of strategy like this. So investors need a long-term perspective and multiple years to eventually see the capital appreciation pay off.